Okay, and welcome back, students who are taking financial accounting. And as I had said in the last video, these are sort of like introductory videos in order to be able to give your mind some kind of framework as to how to think about accounting. And I mean, even though we haven't started in the textbook yet, like I had said, it's to be able to give your mind just a quick overview so that as we start going through the textbook, you'll think back and say, oh, I remember that, I remember this, and it provides another reference. So in the last video we had finished by uh, looking at the process of getting information into our journals, posting it to our ledger accounts, and then being able to create our financial statements. But there's a process to it, and it's called the accounting cycle. Okay, and the way this works is, let me get our pen here. Okay, an accounting cycle is a period of time. All right, now not all businesses are alike, so the periods of time vary. I mean, a small mom and pop business, their accounting cycle might be 1 year. Why? Because all they're interested in is the end of the year when it comes time to file their taxes. Okay, they've been doing it for a long time, and they have a seat of they go by the seat of their pants. They know that at certain times of year they get a little bit more busy, other times of year they get less. They're not so interested in analysis and whatever have you. So they might have an accounting cycle of a year, and that's very, very common for many, many small businesses. Um, you can have accounting cycles every 6 months, which is not as common, or quarterly. All right, let me get my writing here better. Or every 3 months, which is quarterly. Right, QUQTRLY. There we go. My writing is terrible today. And that's every 3 months. I mean, that's a little bit more common than 6 months. 6 months is almost never used. I mean, it can be used, but it doesn't happen that often. 3 months would be more appropriate, but one of the most common ones is monthly. Okay, which means at the end of every month, that's going to end our accounting cycle, and the next month begins our accounting cycle. So you would have, if you had if it was monthly, that means you would have 12 periods, 12 accounting periods in a year. Okay. Now, it is possible, I mean, some months have 30 days, some months have 31, and one month has 28 days. And so that can skew, depending upon the business, that can skew your numbers a little bit. Okay. So what some businesses will do is they will opt for every 4 weeks. Okay, if you have 52 weeks in a year and you divide it by 4, that gives you 13 accounting periods in a year. Okay, so the most common one used is monthly. Okay, but there are some businesses that will opt for every 4 weeks. Okay, also too, be aware that businesses do not necessarily go from January 1st through December 31st. Okay, that's a calendar year, and a lot of businesses do. Excuse me, but what happens if a business wants to start, say, on July 1st? Okay, they can do that, and of course then their year would go all the way through June 30th of the next year. Okay, so you have, there is this consideration as to what your year looks like. If you're on a calendar year basis, when you go from January 1st to December 31st, then that coincides regardless of whether you're using monthly accounting cycles, HLY. Geez, my handwriting is terrible today. Monthly. Or if you were, say, going on the 4-week cycle, okay, which is 13 periods, this is going to be 1 year, okay? And the nice thing about being on a calendar basis is that it matches up with payroll considerations, because payroll, it goes from January 1st to December 31st as far as taxing is concerned. Okay, so a lot of businesses do try to get started, try to have a calendar period, but it doesn't necessarily have to be that way. If they go from, say, July 1st to June 30th, okay, notice that December 31st, remember, January 1 to December 31 is for payroll considerations, right? And so what ends up happening is there's a little bit extra work in here, because you have to keep track of the figures based upon 2 different time frames, 2 different periods. Okay, so an accounting cycle has a beginning and an end. All right, there's a beginning to the accounting cycle and then to the end of an accounting cycle. And the ending figures for an accounting cycle become the beginning figures for the next accounting cycle, okay, which goes to an end, right? So like this might be for January, okay, so my beginning figures of January, at the end of January, my ending figures now become the beginning figures for February, okay, and then my ending figure, the end of the accounting period in February would become the beginning of March, okay. All right, so that's the way the accounting cycles work. Now, how does that work throughout the accounting period, right? So I had said we start out with the beginning figures for an accounting period, okay? That's our beginning, that can be shown on our beginning trial balance, right? Then we're going to go from the beginning of the accounting cycle all the way to the end, okay? Which then is represented, or maybe I should have put that down here, which goes all the way down to the end, okay? Which then, notice it's a number 1 here, which then becomes our beginning again, right? But for the moment, we're going to start out with beginning figures on our beginning trial balance. And a trial balance is nothing more than a listing of the general ledger accounts and the balances in those accounts as of a specific date. So if we're looking at let's say we're looking at a period for January, and I'm going to deal with monthly instead of every 4 weeks, because most of the teaching material and textbooks and stuff works on a monthly basis, but realize that that's not the way it actually occurs in the real world. You're going to see the different types of different periods of accounting cycle. So if we're looking at January, and this is beginning on January 1st, okay, the end will be January 31st, right? 31st, okay? So on January 1st, we start out with our beginning balances, okay? Then throughout the accounting period, through the whole month of January, transactions are going to occur. And as those transactions occur, we post them to we put them in our journals, okay? We make journal entries. Once they're in the journals, we have to move them to the general ledger accounts, and you can see this on this slide here, right? Here we have our journals and we're making our journal entries, and then we post everything into our general ledger accounts. Okay, well, that's what we're doing here. We start out number 1 with the beginning trial balance. During the accounting period, we make journal entries, which is number 2. Okay, the third step will be then to post to the general ledger accounts. Now, that kind of explains all the way, 1, 2, and 3 up here, right? All the way up to this point in time. But what about this part? Okay. Well, when this is an iterative process, meaning we're always making journal entries and we're always posting to the general ledger, always making journal entries, posting them to the general ledger accounts throughout the accounting period. But when we get to the end of the accounting period, okay, we have to close the accounting cycle. Okay. To close the accounting cycle, we take the information from our general ledger. In other words, we actually create a trial balance, which has our balances, and we create what's called a worksheet, which is step number 4. And in the worksheet, there's several processes that occur. We start out with a pre-adjusted trial balance, meaning this pre-adjusted trial balance has mistakes in it. Okay. Some entries haven't been made. Okay, it's not the end-all be-all. It's not the most accurate figures, and that's why the most accurate figures for the accounting period, and that's why we're working with it as part of our worksheet, because we have these balances, but they're not absolutely correct. That's why it's called pre-adjusted. Now, because they're not accurate, we have to make adjustments to them. We want to make adjustments so that we know that the figures are correct. Right? When we make those adjustments, we're making them in our journals also, and then we post them to the general ledger accounts. Once they're posted to the general ledger accounts, we create another trial balance. That's our adjusted trial balance. Notice this is pre-adjusted, this is adjusted. It happened after we made adjustments. Okay. Now this adjusted trial balance should be correct. Okay, whatever we have on there, we should consider it to be correct. Okay, if it isn't, we go back through making more adjustments and posting to the general ledger accounts until we're absolutely sure that those numbers are right. Okay, because that's going to be the basis. What's on our adjusted trial balance becomes the basis for creating our financial statements, which is what we see up here. So up here, we had made our journal entries, right? We had transactions. We posted them into our ledger accounts. Into our journal accounts. We entered them into our journal accounts. We posted them to our, oh boy, now I'm tongue-tied. We have transactions. We make the entries into our journals, then we post them into our general ledger accounts. Once they're in our general ledger accounts, we work on the worksheet in order to make sure that the balances are correct. When we're absolutely sure the balances are correct, then we can create all of our financial statements, and not before. Okay, so that's where we're at right now. We're at a point where we're able to create our financial statements, balance sheet, income statement, and if we so choose, statement of cash flows, statement of retained earnings. Oh, and just as an FYI, I forgot to mention, it just popped into my head, these are by no means the only 4 financial statements that can be created. We can create all kinds. I mean, when you get into cost accounting, you create cost reduction summaries and blah, 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 okay? But these are the 4 most common ones that are created. So once they're created, right, then we have to finish out closing our books. Why? Because we have to start out a new accounting cycle. All right. So to do that, we create closing journal entries. Right? And basically what that does is just moves information from our income statement to our balance sheet. All right. And when we make those closing entries, they are journal entries. And again, we have to post them to our general ledger accounts. Okay. Once we post them to the general ledger accounts, from the general ledger accounts, we can create a post-closing trial balance. Now, that post-closing trial balance is a listing of the ledger accounts and the balances in those accounts. And since that's post-closing, meaning after we closed, right? Well, that's the last thing that is done in the accounting period, and that post-closing trial balance now becomes our beginning trial balance for the next accounting period. So if this was the process for January, okay, the accounting cycle for January, once we created the post-closing trial balance, that would become our beginning trial balance for February. And we do the same exact thing all over again. And when we got to the end of February, that would become March's trial balance. Okay. So don't get all freaked out over this. All right. I realize it's a lot of information being thrown at you, and it's a lot to take in. And it's by no means meant for you to know it just by listening to it. Okay. Remember from the very first videos, I said that the financial accounting, or accounting in and of itself, is more about understanding concepts in the application, not about memorizing. Okay, the application of this is that you will do it again and again and again. And if you do it again and again and again, and I don't mean just doing the homework problems, even though doing the homework problems gives you the tremendous amount of practice for this, but if you're doing it, the learning is in the doing, and if you're doing it, this process will become instilled in you. I'm providing this as a flow chart, just so that you have some idea in your mind as to what's going on and when it's happening. Okay, and like I said, we're building a framework in your mind so that as you go throughout the textbook, or as you advance further, you'll have some idea as to where you are in the process and how the things fit together. Okay, this here is basically the flow charts for it. You have transactions, they get put into journals, posted to the general ledger accounts. Well, you start out with beginning balances. You have transactions. They are those transactions are put into the journals. The journals are then posted into the ledger accounts, and from there we want to create our financial statements. Okay? And to create the financial statements, we have to go over to a worksheet and use that to be able to help us create those financial statements. So we start out with a pre-adjusted trial balance. We make adjustments so that we know everything is correct, right? And they're posted to the ledger accounts. From the ledger accounts, we're able to create an adjusted trial balance, and since those numbers are all correct, that allows us to create financial statements. But our books aren't closed yet to be able to start the next accounting period, so we have to make closing journal entries, and when we do, we post them to the ledger accounts. And once they're posted, we're able to create a post-closing trial balance, which is the beginning balances for the next accounting period. So it just goes around. Notice the flow. It's going to just keep on going around again and again, one period to the next to the next. And like I said, this here is just to give you a mindset to be able to work with the financial accounting, so you're not really lost. Right? Now, one last thing before I end this video, and after, when I end this video, we'll actually start working on the chapter 1 in the book itself. Realize that again, this is concepts and it's processes, and there's no hard and fast rule as to how the information is presented, although all of the information needs to follow the principles. Okay, it doesn't matter whether I see information in a vertical format or a horizontal format. I mean, it does, because that's the way I want to see it, but it can be adapted whichever way. I can use whatever forms I want. It's not about the lines on the paper. Okay, there's a lot of flexibility in here in accounting, and that's what allows it to work so fabulously. Okay, because of the flexibility, but the adherence to the principles, so that everybody understands When I hand you a financial statement, if you understand generally accepted accounting principles, you're able to understand that financial statement. If I'm not, you're able to compare apples with apples, okay? If I was doing my own thing and you're doing your own thing, and I hand you my financial statement and we're not following the standard set of principles, then you wouldn't have any idea what I'm doing. And this here process allows that all to happen so that you could compare a Microsoft with a Google, with a Facebook, with an Apple, with biomedical, with entertainment industry, with a mom and pop, ice cream shop. They all follow the same principles, and if you understand the principles and concepts, you're able to understand, the mom and pop all the way up to Google or Facebook if you want. Okay. So with that said, I'm done, and as we go forward, remember, you'll be able to watch the videos again, and if you still don't understand something, feel free to call and speak with an instructor. Okay. So with that said, I'm done with this video, and we'll actually start working in the textbook in the next video.